Okay, so apologies for the delay. We have a bit of a technical issue with the live streaming on YouTube, so unfortunately we are going to have to upload it afterwards. This is being recorded, so hope everybody is okay with that. And then it's going to be uploaded to YouTube afterwards. But yeah, so can everybody hear us on Zoom? Really? I hope. Yeah. Yeah. Okay. Yeah. So, welcome everybody. Thanks for coming. And so this is the second year of this lecture series hosted by SOAS, Economics Department, and the Economics Department in the New School for Social Research. We're really excited to kick off this second year series. So last year, we focused more on the theoretical analysis, and so building on from there, this year, we want to bring you the discussion more relevant to our day-to-day life with the theme of crisis of capitalism. So the last lecture, in the final lecture of last year, we did a hybrid, and then it got like a lot of positive feedback. So we decided to continue doing that. So it's really good to see the room full of people and then a lot of people on Zoom. And so this year, people on Zoom will also be able to ask the question yourself. So if you have a question, please leave it on the Q&A box, and you should also be able to upvote. So we will ask in order based on the the questions that got most upvotes. Yes. And yeah, obviously people here, you can also ask the question yourself, and there will be a bit of like reception afterwards, so stick around for a little drinks with us. And yes, before I introduce today's speaker, Costas, if we want to hear a little bit from our organizers across the pond from New York. Hanin, did you want to come and speak?
Hi, Wani. Hi, everyone. Thank you for joining. I'm looking forward to this year's lecture series.
Great. Okay, so let me quickly introduce today's speaker, Professor Costas Lapavitsas. I know he doesn't need a lot of introduction, but he is the professor of economics here at SOAS, and he has written numerous books, including Left Case Against the EU, Profiting Without Producing, How Finance Exploits Us All, and he was a member of parliament in Greece in 2015, and has been closely involved in social movements here in the UK and globally. So the most recent publication of his includes The Cost of Living Crisis and How to Get Out of It, written in collaboration with GFTU, the General Federation of Trade Unions, and PEF, the Progressive Economic Forum. And there's also a new book called The State of Capitalism, Economy, Society, and Hegemony, published by Perso. You can order it on the website as well. So without further ado, I know you've been waiting for a while, so Costas, the floor is yours.
Thank you very much, Hanin, for the introduction. I hope you can see me, and I hope the technology holds. It's an ambitious thing that we've been doing. This is the second year. It worked very well last year, and there is no reason why it shouldn't work very well this year too, and why it shouldn't become a regular feature, a sort of collaboration and cooperation across the Atlantic among basically leading centers of political economy that can produce something useful about contemporary capitalism, new ideas and new analyses that we desperately need at the moment. I wish to thank the PhD students at SOAS and the new school for doing much of the coordinating and organizing work. It's a student-led initiative to a large extent. That's how it should be, for it to produce the kind of results we wish it to produce. Anyway, enough of the general introductions. Let's get to the meat of it. And the meat of it, as Juani also already said, is basically a presentation about how to make sense of what we have called the interregnum. The interregnum since 2007, 2009, since the great crisis of 2007, 2009, the structural crisis of that time. Basically, the last 15 years, how to make sense of it and how to follow it, what characterizations are there. I want to say that this is obviously the topic of our new book, which Juani has already mentioned. It's just come out. And this book is unusual in the sense that it is a collective output. It's not a collected volume, it's a collective output. It's part of the EReNSEP Writing Collective. Several of us. We collaborated and cooperated. We produced a single voice at the end. Those of you who've been involved in producing work jointly, you will appreciate how difficult that is. But we believe that this was the only way to do it, because we're trying to characterize a broad period. We're trying to give an overview of a very broad and difficult period, an overview that places core and periphery of capitalism in the current context. That requires many types of knowledge and many different specializations. And there is no single individual who can actually usefully do that today. It doesn't exist. And I say that for those among you who are ambitious, you should be ambitious about political economy. Some things are by individuals, and characterizing such a period is okay. So anyway, we tried and we've done it, and you will see. So the point I want to make is that this is a synthetic work, right? We bring together different types of knowledge and we generate a picture of where capitalism, global capitalism is. The key point then for us, and I'll tell you at the outset, is that since 2007, 2009, the world economy is in what we've called an interregnum. Can you hear me better now? Okay, yes. The world economy is in what we've called an interregnum. Now, an interregnum is a term we took from Antonio Gramsci, for those of you who are familiar with this kind of analysis. Gramsci, of course, used it for the domestic context fundamentally. We use it for the global, the world economy. Then the idea is very closely related. And what Gramsci meant by the interregnum was a period in which the domestic social and economic arrangements of a capitalist formation are such that the old cannot continue, but the new cannot be born. The world is lodged in the state of affairs in which it cannot go forward. And it keeps churning and turning round and round without finding a new direction ahead. For us, this was the characterization that is very appropriate for the current state of the world economy for reasons that I will explain. So we use the term in this respect. And I hope to justify the use as the discussion proceeds. The one point I want to make at the outset, and that is this. For Gramsci, an interregnum is a dangerous period. It's a very dangerous period because if the system keeps churning over without going forward, if the new cannot be born, but the old cannot continue, then that gives birth to monsters. It's a time that gives birth to monsters, political monsters and social monsters. And I think that's the period that we're living through. Unbelievable historical monsters. And I would add something which perhaps did not directly discuss. The current interregnum is a period of monsters that lead to war. This is a period of the most incredible intensification of the risk of war and militarization. And that is not accidental. That has to do with the patterns of development of the global system, as I hope to explain as we move along. Now, let me open up then by posing a methodological issue. How to grasp it, how to grasp the Interregnum, how to grasp the characterization of such a complex and long period that spreads across so many parts of the world. I have to say at the outset that you do these things, you talk about concepts and so on in political economy, and then gradually you come to realize, and I've been doing it for a long time, that you come to realize that certain ideas that you take for granted, others cannot. And that has to do with the general retreat of political economy, particularly Marxist political economy, in the last several decades. And it's an astonishing thing to know. Key concepts that used to make meaning in my generation are not meaning anymore. So I wish to stress a couple of points which are very important for what I'm going to say. And that is this. We're engaging in historical or period characterization by construction, right? That's what we want to do. We want to tell you what's happening in the last 15 years. What is this Interregnum? And in many ways, this kind of characterization is the most difficult thing you can do in political economy. Why? Because it's an in-between thing. In political economy, you can do pure theory. Or pure economics. You can consider how capital moves at the level of the market, of the individual enterprise, at the level of the sector of an economy, and you can theorize it. You can do concrete study of how a particular economy behaves. You can look at the economy, I don't know, of Uruguay, or the economy of Mozambique, and tell me how it works concretely. Both of these things are feasible, and we've got well worked out means for doing that. But here we're not doing that. We're having an overview of 15 years, which require both theory and historical and other evidence. And how you blend the two is the most difficult thing you can do in political economy. It's middle range theory. And middle range theory is very difficult. A lot of people do look down upon it because they don't understand the difficulty. They think that they can generalize. So I want to point out some of the difficulties involved here. Historically, in the political economy, Marxist political economy tradition, periodization is something which has been engaged by many people, and classically we categorize, periodize capitalism by looking at, I will give you my understanding. You can do what you may with it. Laissez-faire capitalism of the middle of the 19th century, with Britain being the prime example, right? The workshop of the world. Followed by what is usually called monopoly capitalism, in which British supremacy was gradually overcome, and yet the rise of other powers. Followed by what is called typically imperialism, the imperialist period in which banks and monopoly capitals were welded together and created finance capital and expanded. Followed by what some people have called state monopoly capitalism after the Second World War. Not necessarily universally accepted categorization, but it exists. I don't want to discuss these. All I want to say is that the presentation I will give you of the Interregnum comes from an understanding of what has been happening since the early 1970s in period terms. And since the early 1970s, I would argue, the period we've been living through is the period of globalized and financialized capitalism. The combination of globalized production, which I will explain in a minute, and globalized finance is the characteristic feature of the last 50 years with the neoliberal ideology. Neoliberalism is not a period. I say that because a lot of people say the neoliberal period. There's no neoliberalism in this period. Neoliberalism is an ideology and it's policy. But if you're going to characterize the period, you've got to look at globalization in ways that I will explain, and in financialization in ways that I will explain. The Interregnum then, in this context, is the end of that period. It's the exhaustion of that period. It's the exhaustion of globalization, the exhaustion of financialization, and the lack of a clear direction ahead. It's in this respect that it is a time of monsters. What then are the analytical principles that we would use, that we do use in our book? If you take this approach, of what I would say is fairly classical Marxist political economy, you're going to be looking at three things, three areas, in order to characterize it. First, as always, in this kind of political economy, production. You've got to start with production. So I'll show you some evidence and we will discuss the characteristics of production in this period, focusing on the interregnum. Second, you're going to look at finance. Finance being very, very important in capitalism anyway, and in the period that we'll be living through, extraordinarily important. And third, in our times, you're going to be looking at the state and how the state intervenes or does not intervene in how the economy works. So the characterization of the period that I will give you develops along these three axes: production, finance, and the state. Hence the title, The State of Capitalism. Right? What matters here, particularly for the state, and what is extraordinarily significant for our times, is that when you look at the state, I don't want to get into fiscal policy and monetary policy, although I'll mention these things. What is extraordinary is the struggle for hegemony. Is the hegemonic contest that has re-emerged with a vengeance in our times during the interregnum, and what used to be called, and rightly so, imperialist contests. And it is this that needs explaining, this that needs understanding. If the characterization is to mean anything, it is this that needs explaining. Some kind of political economy-based explanation and understanding of the drive towards war, which is evident. Never in my lifetime have I seen such an intensification of the drive towards war. And that needs a political explanation, political economy explanation, which of course goes together with what I would call the decline of US hegemony during this period and the intensification of hegemonic contests. That then is what I plan to do, and I've got all of 20 minutes to do it. Let's start with production. Now, we've looked at it at two levels. The first, what we might call the macro level. And we looked at production at the macro level at the core. I will define the core as we move along. Just take it as a heuristic term right now, right? At the core of the world economy. So production then at the core, accumulation in other words, for us, has been characterized by sustained weakness. And that's the characteristic feature of the interregnum, sustained weakness. The gross figures leave no doubt at all about it. You can see it in terms of rates of growth. The 2010s were the worst decade since the 70s in terms of growth rates. The 2020s are shaping up very badly already. We don't know how they're going to turn out, but the outlook is not very good. So accumulation is not proceeding rapidly, and the reason is, the question is why. One key feature here at the core of the world economy is very weak productivity growth. Very weak productivity growth. It's an extraordinary feature that has been around for a long time and crucial during the times of the interregnum. Productivity growth has been non-existent in key countries the last 15 years. And that goes together with two things. Weakness of investment. Investment has been very, very weak. And somehow an inability of the new technologies, about which so much has been said, to raise the average productivity of labor. Not the productivity of labor in key sectors, possibly in industry or manufacturing, the average productivity of labor. That almost certainly has got something to do with the division between services and non-services, and the weakness of technology in raising productivity of labor in services, which characterize key capitalism, core capitalism today. The second aspect of this accumulation weakness is the proliferation of zombie firms, which we've documented. Zombie firms in the sense of key productive units, which are not profitable enough even to generate profits to cover their financial expenditures, to cover the costs of their borrowings. That is an extraordinary weakness, and the ability of these firms to survive is an indication of accumulation weakness. The last point I want to make here, I could have said a lot more, but I haven't got the time, is of course the behavior of profitability. In much of Marxist economics today, there's a kind of theology of the profit rate. I've never personally subscribed to it. Rate of profit is very important, but the idea that the rate of profit explains everything, past, present, and future, is not really good economics. However, we look at the rate of profit because it captures key aspects of how accumulation has been performing and conducting itself over a period of time. And if you look at how we estimate the profit rates, and we estimate them for the United States, because the figures are best for the United States, and because it is the leading economy in the world. If you look at profit rates since the early 90s, what you will see is basically a kind of flatlining with strong cyclical behavior. There is no upward or downward trend that we could identify. I know you can get into all kinds of theological calculations, and I avoid them. This is basically what comes out when you do the states stuff using NIPA data. So, and what you can see is that after the great crisis of 2007-2009, the rate of profit does not pick up seriously. The pandemic is different, and I'll have more to say about that as we go along. Not now at the macro level. Weakness. What might be called sustained inability to produce, long-term inability to grow rapidly, recognized by key neoclassical mainstream economists to stagnation, long-term stagnation. Not at the macro level. At the micro level, when we look at production, things become much more equally interesting. And at the micro level, what we put our focus on was the emergence, still in production, of global value chains, which we think is the characteristic feature of the period preceding the Interregnum and the Interregnum itself. What is different about global value chains and characterizes the period is the extraordinary globalization, internationalization of productive capital. I want to stress that because capital is international from the beginning, from birth, right? It's an international aspect, a national phenomenon. But not all forms of capital become international with equal facility. Money capital is easily international. Commodity capital is also easily international. You can transact in commodities, you can export and import across borders fairly easily, and you can send money across borders fairly easily. Productive capital, producing across borders, is a different story altogether, because productive capital has got far more pressing and imperative requirements than commodity capital and than money capital for internationalization. Productive capital requires access to appropriate labor across borders, which is skilled and cheap enough. Second, it requires institutions, local institutions that can support production and the continuation of production over time, and these are not under the control of capital necessarily. Third, it requires the ability to move out. So it requires a framework which allows capital to move out. In other words, it requires fluidity, despite the fixity of capacity. It fixes capacity in place, but it requires fluidity as well. And that fluidity must be somehow ensured. What is striking about the period of the Interregnum just before is that this fluidity and fixity has been established through absence of property rights. That's the first time in the history of capitalism we see that. Capital has transgressed borders before and established capacity afterward. That capacity has all typically been subsidiaries and so on, with direct property rights exercised over them by their mother enterprise. What we've seen in the last 3 decades, and definitely in the period of the Interregnum, is the ability to do that without property rights. The ability to create global production capacity without necessarily owning it. There hasn't been anything like that in developed countries. It is reminiscent of the putting out system through which capitalism emerged, except that now it's global, and it is much more than the putting out system. But it is reminiscent of that. It's like a global putting out system in which key multinationals, core multinationals, exercise control, but the control is exercised without property rights. The control is exercised through controlling technology, through controlling access to finance, and through setting prices within the chain. Now, I'm generalizing, and there are many other types, but this is crucially important. So it is an era of giant multinationals at the micro level, operating in this complex manner in both core and periphery. And that matters for how core and periphery unfold. Not much about production, I could have said more, but I don't want to say it every time. So let's move to finance and characterize finance. The period of finance for us that we're looking at, obviously began earlier than the Interregnum, is the period of financialization. Now, the world and his second cousin are talking about financialization these days. Everybody talks about it. And they're right, because it's a strong feature of contemporary capitalism. Question is, how do you approach it? Well, the approach here is as a structural element and an epochal element, something that defines the period. Okay? And when you do that, you arrive at a couple of points about the financial institutions, also about the non-financial, because I haven't got time to do it at this stage, but the financial institutions which are of paramount importance. We can think of financialization operating through commercial banks in the first instance, in a sense, the golden period, the golden era of that, the 90s and 2000s, operating through commercial banks, emanating from the core. These commercial banks, I wish to stress, have got a significant distance from the non-financials. I stress this because people get very confused about it. Productive capital, such as some did that already, productive capital obviously borrows and obviously uses finance. It doesn't depend on finance. It doesn't depend, it actually depends on retained earnings more than anything. The large multinationals that I outlined just before are sitting on enormous piles of liquid funds. If you do that, you don't rely on banks. You rely on banks when you need funds to finance your investment. So the characteristic feature of commercial banks in the period of rapid development financialization was a degree of distance from non-financials and the involvement of banks in market operations, becoming market transactors and lending to households and making profits in this particular way. This period was very, very powerful and secured profits, which I will show you in a minute. And it basically came to an end with the great crisis of 2007-2009. During that period, especially towards the end, and certainly since 2007-2009, what we witness is the rise of shadow banking. And the current stage of financialization in the Interregnum is dominated by shadow banks. Now, what do we mean by shadow banks? Well, shadow banks means basically non-commercial banks. But here, we mean by them institutions which basically manage portfolios, portfolio managers. And that's how you can distinguish them from commercial banks. Not lenders for productive purposes, portfolio managers, people who specialize in handling large asset portfolios in financial markets and make their profits out of financial asset transactions. What's striking about these institutions is the incredible concentration of property. Figures for the early 2020s for the United States are extraordinary. 3 of these shadow banks control something like 25% of the entire equity of the United States. They hold it. And here is a shift away from bank-based financialization towards essentially shadow bank with internationalization. But that has happened while the overall profitability of financialization and finances also profits is flatlined. So if I show you the estimations we made, profit rates, or rather profits, not rates, because the standardizing element there is not capital, but GDP. So it's basically non-financial profit and financial profit relative to GDP, right? It's a kind of rate, but not the rate of profit. Nonetheless, it gives you a sense of proportion. What you see is the extraordinary increase of financial profit as proportion of total profits and relative to GDP until 2007, 2009. Then there is a collapse. It bounces back and then it begins to flatline at a fairly high level. That's the period we're in. And it is very important to grasp it for a further reason. And that is now the opposite. It's the macro reason, if you like. We go to the global dimension. Finance, as it's done that, has also become global. Financialization is about the global spread, about both for commercial banks and for shadow banks. Finance has always been global, of course, and global long before productive capital became global, of course. But the characteristic feature of this globalization of finance during this period of financialization is the shift from development finance to what is rightly being called, we call it diversification finance. In other words, finance which is dominated by portfolio management. The capital flows that characterize the modern global dimension of finance, the capital flows are driven by portfolio decisions by private portfolio managers, private portfolio holders, and that dictates capital flows, portfolio flows, bank flows, and FDI flows. It's a noble development. I want you to appreciate that. It's a noble development. If you look at the period of capitalism since the Second World War, it's a characteristic development. It is this that makes for subordinate integration of a whole range of countries into the global financial markets. It is this that has recreated core and periphery in crucial ways, together with the globalization of production that I've already mentioned. This kind of globalized finance, driven by shadow banks today, of course, pivots on the existence of world money, pivots on the existence of a form of value that can prevail in global financial markets, which is generally acceptable and can be used to retain value and to make payments. And that's, of course, the US dollar. So it pivots on world money, and that begins to define for you what we call subordinate integration. Why? Most countries have got their own currency. There's only $1. However, what you also have in the global financial markets is a hierarchy of currencies. So the hierarchy of currencies is really what defines subordinate integration. Hierarchy of currencies is very difficult. It's very easy to see and very difficult to analyze. And the root of it, what makes it emerge, is a hierarchy of balance sheets in the global financial markets. It is the ability to create this kind of fiduciary money by the United States and by others, which happens in a system of subordination of balance sheets. Why? Because access to world money for countries that wish to participate essentially involves swapping parts of the balance sheet of central banks. Having access to the balance sheet of the Central Bank of the United States. That's basically what it amounts to. That is a very difficult and complex concept, and it is based on a hierarchy of private balance sheets and public balance sheets. That is one of the most complex characteristics of contemporary capitalism and subordination at that level. Which brings me to the third issue. I have a lot more to say on finance, you can imagine, but I haven't got the time. Which brings me to the third issue, which is the extraordinary law, unprecedented role of the state. We've got globalized finance, dominated by shadow banks, and we've got globalized production, dominated by multinational enterprises, essentially. In this world, this globalized, financialized capitalism, the neoliberal concepts that my generation grew up with, and which are still very popular in the textbooks and elsewhere, of the market versus the state, the market dominating the state and the state retreating, are entirely without meaning. These are devoid of meaning. What is striking about this world is that these neoliberal precepts do not apply And the easiest way to show it is by going back to the point I made originally, which is how to think of core and periphery. Right? The easiest way to find it is to look at the role of the state, is to look at how the state acts at what we might think of as the core and how it acts in the periphery. That would make us understand how the state is involved in this contemporary arrangement. At the core, state power comes primarily from command over domestic fiat money. Again, this is an unprecedented event in the history of capitalism. It doesn't come from direct command over resources. It doesn't come from control over investment. State doesn't control that at the core. It comes from controlling essentially central bank created fiat money. The key economic institution of the core countries of the world economy today is the central bank. Who's to stress that to most of you this seems natural? It is incredibly unnatural. There's never been a period in the history of capitalism where the central bank is banned from us. Is the dominant economic institution of such powerful countries as the United States or issues of countries in Europe and so on. The central bank provides this power by creating fiat money via buying financial assets, mostly public assets, but also private assets. Essentially then, what happens is the power of the state comes from borrowing, much of which is monetized by the central bank by creating money, which is in a sense forced circulation. It's fiat money. Let me show you what this means in Europe. How the EReNSEP matters. This is the liabilities of the European Central Bank, not the dominant central bank, not the Federal Reserve, and a central bank which presumably was never going to do that, the European Central Bank. But it's beginning to look very much like the Federal Reserve. And you can see it begins around 2007, 2008, 2009, an explosion of liabilities, which are basically money creation by the European Central Bank, which doesn't have a state to control it. It's a very peculiar bank. Nonetheless, it behaves in this way. And obviously, what allows you to do that is the extraordinary growth of the asset side, which is basically driven by public debt purchases, which the European Central Bank was not supposed to do. Here, then, we've got a simple demonstration of the extraordinary peculiarity of the Interregnum. This is the single most important feature characterizing it. What does this tell you? It tells you that the state, through control over public fiat money, can direct aggregate demand. It can impact on aggregate demand. The ability to impact on aggregate demand is extraordinary. Austerity is a choice. In other words, austerity, there's nothing that comes from within the logic of capital. A lot of people have tried to say that. I don't think so. It doesn't come from the essential logic of capital. It's a choice. And we saw that in the pandemic period when, there, you can see the pandemic. It's the jump at the end, the extraordinary jump of money creation and borrowing at the end. Intervention then to manage aggregate demand characterizes core states. They can do it, and they do it as and when they need it. What they don't do, and that is the true content of neoliberalism, is two things. First, they don't intervene when it comes to property rights. They don't alter the balance of property rights. That they don't do. In other words, they don't nationalize if they can help it. Okay? And the second thing that they don't do is they don't intervene in the balance of labor versus capital, except in the interest of capital. So they don't transform accumulation. There's nothing transformative about the intervention in finance and production that I outlined. At the same time, we will discuss that, but I will come to call it. Core states are repressive when it comes to democracy, and they operate these policies through a loss of popular sovereignty. democracy and popular sovereignty go together. The period that I've outlined in these economic tensions go together with loss of popular sovereignty, that matters. I'll say more about it. And let's come to periphery. Peripheral states cannot do that. Peripheral states do not have capacity to intervene in that way, even though they themselves produce state-created fiat money. So the ability to create fiat money doesn't give you the ability to do what core states do, right? Why? Subordinate integration. The meaning of subordination emerges very clearly in our context. Subordinate integration in the sense that integrating into global finance through the capital flows that I outlined before and through the global value chains means that you depend on world money, you depend on the flows of capital and on world money, in other words, the dollar as reserve currency, and that creates subordination. Subordination here should be understood as a systematic limitation of policy space. Core countries, states of core countries, have got extraordinary capacity to intervene because of command over domestic money. The central bank, understand the periphery today. It's very, very important to focus on that. To realize that one key element here is that peripheral states, not all, but significant proportion, large proportion, do have their own state-produced fiat money, but that doesn't give them the same policy space that core states. That is the content of subordination. You understand? Otherwise, subordination is an abstract meaning. The content, one key element of subordination is precisely this. Subordinate integration is precisely this, and it operates through the idea that I gave before of hierarchy of currencies and hierarchy of balance sheets, which for peripheral countries amounts to dependence on capital flows and to access to the dollar as world money, as the key reserve currency in the world. And the subordination dimension is basically, if you wish to participate in globalized production and global finance, then that restricts policy space. And it can restrict policy space enormously, and that's a reflection of, that's what subordination means. During the interregnum then, I don't have time to go into more detail on this, but I'll give you the gist of it. During the interregnum then, the content of core and periphery in contemporary capitalism has become clearer. This idea is very old. It goes back more than a century, okay? But the way in which it exists in the current situation is quite different, to be clear. And it has become clearer in the course of the interregnum. To be sure there is imperialism, and to be sure there is domination, which I mentioned. Subordination, the opposite is domination, obviously. To be sure that exists. But it's important to understand how it works and to locate the economic foundations which I've already outlined, but I'll repeat. Because you see, you can decry imperialism and you can decry hegemonic contests on moral grounds. A lot of people do. It's not difficult. It's not difficult. What makes the Marxist approach different and gives it special meaning is not the moral criticism of imperialism or the moral criticism of domination. So many people do that, and often better than Marxist critical economics, right? What gives it content is actually the attempt to connect that with the basic functioning of capital, the key forms of capital underneath. That's what gives it particular purchase, insofar as it can be achieved. Historically, we know that imperialism was defined by, in the times of classical Marxism, by Hilferding, Lenin, and others. I don't want to go into these debates. On the grounds of how capital works, on the grounds of finance capital. Finance capital, which I've already mentioned previously, the amalgamation of banks with productive enterprises, banks being dominant and dictating the terms on which productive enterprises operate, setting the terms of how productive enterprises work. a lot of people make a parallel and an analog of today's conditions with that, particularly because we talk about financialization. So it's very easy to say that contemporary imperialism and contemporary domination is very much an analog of that time, whereby finance and financial institutions, maybe the shadow banks I mentioned before, or the commercial banks, set the terms for the behavior of the world economy and dictate terms to corporate, non-financial enterprises. Yeah, well, I've got news. That's not how it works. That's not how it works. That is not how contemporary expansion and so on works, for reasons that I've outlined. Global value chains, globalized productive capital doesn't depend on banks. It's not determined, its behavior is not dictated by banks. Of course it needs banks, and of course it interacts with globalized financial capital, but it's not a relationship of domination of productive capital by finance. That's not how it works. It's a pairing of capitals that feed off each other. That's what drives the contemporary economy. And this pairing of capital, I would argue, is the most aggressive form of capital in the history of capitalism. It's a combination of capitals that basically sees the world economy as its natural terrain. That it seeks to dominate the world economy. It seeks to cover every part of the world, and in so doing, it has redefined the periphery in new terms. The periphery, you see, historically, has often meant a situation in which the core is capitalistic, and countries in the periphery, what we often call the global south, contains large non-capitalist areas. You understand? It contains entire areas of the economy which are non-capitalistic, different social relations which are non-capitalistic. Well, you try and find them these today. The world is dominated by the kinds of capitals that I mentioned, and the behavior of peripheral economies is dictated by capital logic and the operations of capital. So core and periphery today are redefined entirely on capitalist grounds. There is no non-capitalist world in which the capitalist send the moves and exploits. There is exploitation and there is surplus transfer, but it takes place on capitalistic grounds, driven by the pairing of productive capital and financial capital that I mentioned before. And that is redefined hegemony. That is redefined hegemony. There is no formal empire, of course. Modern capital, unlike finance capital of the past, doesn't need territorial exclusivity. The financial capital or the finance capital of the classical period sent capital abroad, but it sought territorial exclusivity. It drew lines on the map of the world and created time barriers and created boundaries between its own territory and that of the competing finance capitals. It created empires. And the battle for empires and territorial division of the world led to the First World War. There is no similar process today, although there is a process of drive towards war. There is no process of that today. Domination today doesn't need territorial exclusivity, but it's based on world money that I mentioned before. What is peculiar about the classical theories of imperialism, the Marxist theories of imperialism, sophisticated as they are, and I repeat, not in moral terms, because in moral terms everybody can decry imperialism, but in economic terms. What is peculiar about those older theories is that world money is absent. You read the classics, even Lenin and so on, and it's as if the gold standard, which was the world money of the time, doesn't exist. It's facing them, it's there, but they don't see it. And yet we know, 100 years later, that the British Empire and its contest with the German rising empire, also people that don't control over world money, also people that don't control over the gold standard. It was very important to British imperialism. Well, if it was important to British imperialism, it's fundamental to US imperialism. There is no explaining hegemony today, no explaining imperialism today without direct reference to the dollar. Anybody who attempts to do that, it talks nonsense. So to understand hegemony today, we've got to explain world money and how it functions, and the hierarchy of other currencies and the hierarchy of balance sheets across the world that are pointed out. The second thing that hegemony then needs, goes together with the world money dimension that I mentioned, is, of course, the institutional framework within which the global performance of productive capital and financial capital can take place. These capitals are aggressive and they want to engulf the world. For that, they need an institutional framework, what Trotsky called the channel of accumulation. That's the set of institutions within which production and accumulation takes place. And that at the world level means investment rules, trade rules, accounting rules, even measures and weights. These are the fundamental mechanisms of transacting. Whoever sets these terms is hegemony. And the battle for hegemony involves battling over world money and battling for who sets the rules of the game globally. That obviously then goes together with subordination, subordinate capacity to do it, and denial of some national sovereignty as a result. So the modern state doesn't simply deny popular sovereignty at core, in both core and periphery, it also denies national sovereignty at the global level through the operations of this sparing of capital. So to us, that's crucial to explaining contemporary hegemony contests and the drive for war, giving it an economic dimension by connecting it to these globalized forms of capital. When you look at that context, and when you look at hegemony in this context of the drive towards war, one thing is incredibly striking. Yes, the United States is the dominant hegemonic power. It has been for decades. And yes, it's also obvious that its ability to hegemonize is on the way. That's clear. Anybody who doesn't see that doesn't recognize the world for what it is. The question is, where do the contestants come from? And what's striking is that none of the main contestants come from the established imperialist powers. And the difference with 1914 and the history of imperialist contestations up to now is striking. In this tradition, we're used to explaining imperialist battles and wars by looking at the conflict between established imperialist powers. And one dominates the other, and then they fight it out. Where is that showing? What I see is the United States dominating the established traditional powers, kind almost of ultra-imperialism, what Kautsky called ultra-imperialism in this context. That doesn't mean that there is no contestation. Far from it, the contestation is virulent, but it doesn't come from within the imperialist camp. And that's the first time we've seen that. We've seen that being demonstrated in the incredible war in Ukraine and in the even worse thing that's emerging in the Middle East at the moment. I don't know if it's even worse. The even more dangerous thing that's emerging in the Middle East at the moment. So the contestation comes from outside, and it comes from what I've called the old periphery. All the contestants come from the periphery. The key one is obviously China. Russia is close to the BRICS, essentially. And the reason is obvious. The globalization of productive capital and the globalization of finance has facilitated, together with the state, the emergence of independent capitalist accumulation in what used to be the periphery. That's the world we're living in, and these rising powers in what used to be the periphery will not have US hegemony in the terms in which it existed before, setting the terms of the economic game and dominating world money. But things are not straightforward for reasons that I will point out here. When you look at value added, if I can get it to show,
you press down. Maybe you can do the right. It's the next slide, right?
Yes. Why is it?
Yeah, I think they're connected. Yeah.
Okay, so if you look at manufacturing value added, which we've done with some data, if you look at manufacturing, in other words, if you look at the productive capacity, which is behind the tale I told you about weakness of accumulation and globalization of it, you see the story. The workshop of the world is definitely China. Productive capacity is going to China. That's the core of it. And manufacturing value added in China is equal to everybody else added together. So there's no question about whether manufacturing power has moved and the ability of the Chinese contestant to do better than the US. If you look at trade, the US was still the leading power until recently, not any longer. China, then, if you add the imports and exports, has emerged as the main trading power in the world. As per traditional imperialism, both trade and manufacturing need the state, the reasons that I've outlined. When you look at the state, what it means in the end, the power of the state is war expenditure. When you look at war expenditure, you see what's happening to it. War meaning the budget. Now, we know that military budgets are very difficult things to establish with any kind of accuracy. There are all kinds of spending which are not there, which you cannot get access to. There are all kinds of spending which are different from what they appear. Still, you get the picture. The United States has a spending of the order of close to $1 trillion annually. China has been increasing its military spending enormously. The United States spends a lot of money on military bases, which is the foundation of hegemony. China spends it on armaments, and then all the other countries, including Russia and India. What's extraordinary about that, and the United States military power, which we should bear in mind, is that a lot of that spending, which is enormous, seems to have been pointless. And that's something which we will see in time. The United States superpower, the hegemony, seems to be spending a lot of money on military players, huge amounts of money, with very little to show. The bang for the buck is very limited compared to others. And that is interesting for how the unfolding contestations will go. I don't want to say anymore because I'm not a military person, but I can see that. So, to come back to it then. The paradox of US hegemony is that it's in command of the old imperialists, but it's weaker in relation to the new contestants. Not in armaments, although even that is being changed, but in other respects. This, in a nutshell, and I will finish pretty soon, is the foundation for us of this, for what might be called the tensest period in world politics that I can remember, that I can see for decades. The Interregnum is a period leading to war. We have no doubt about that. And in this regard, it is similar to 1914. It's not driven by finance capital for reasons that I've explained. It's driven by the pairing of these capitals rather than banks dominating. But it gives to the contestation an economic foundation. This is the first time we've seen that since 1914. In 1914, the world went to war because, argued Marxists, there was an economic contest underneath. In the period that followed, the period of contestation between the Soviet Union and the United States, or the period of domination of the world by the United States, there was no economic contestation per se. Hegemony was driven by ideological and political contests. Now it is driven again by economic contestation, and that makes it far more embedded and far more dangerous, and far less amenable of balance and stability compared to the previous period. I'm sorry to sound dispirited, but that's the world the way we see it the last 10, 15 years. However, although I've mentioned that the United States is declining in hegemonic power, the contest is far from settled. The United States is not Britain. It's a continental economy. So the contest is far from settled, and the key element that makes for a difference in hegemonic contest is still command over finance. The United States has lost command over commanding power over manufacturing and trade. It still commands finance, and it commands world money. Its command over world money will not change easily. I keep reading things about de-dollarization. Most of these things exist in people's heads. Similarly to the British position and sterling and pound sterling. Sterling continued to be important long after Britain had declined as an imperial power. It is in some ways similar to that. The United States has a dominant position in finance, and the arguments about de-dollarization are not persuasive. All you've got to do is look at this, which you estimate. But I know it's a bit difficult to see, but this basically is a decomposition of reserves. The top thing is the dollar. The dollar is declining, but it's declining from 62%, 64% of total reserves to 59%. I mean, it's hardly the most striking decline. The euro, which is the other line underneath, is not going anywhere. So certainly the euro is not emerging as a contestant representative of value globally. What you get is the rise of its and bits at the bottom. In other words, the British pound, the Japanese yen, the Chinese renminbi, which is less than 3%. These are some transactions. The Australian dollar, and so on. What is interesting then is that as US hegemony declines, and the American government is doing everything it can to promote that decline by sequestrating Russian dollars and the dollars of other reserve holders, as that happens, we're not witnessing the rise of a new challenging currency, certainly not the Chinese money. And the reason why the Chinese money cannot easily do it is obvious. It's obvious. China has reached the stage it has reached in production and trade through state control over finance and state control over capital flows. If I'm an Indonesian capital holder, I wouldn't easily hold my money in renminbi, right? Because I wouldn't necessarily know where my money would go. And because the financial markets are neither free nor easy to move money around. That gives residual power to the United States. What will happen ahead is a very important question, and we touch upon it in our work, by looking at, of course, new forms of money, the digital currencies that are emerging, which might change the rules of the game in this regard. We shall see how that pans out, particularly with central bank digital currencies, but also private digital currencies. That is one of the most interesting areas, but it is speculation to see and to say how that would unfold. The bare fact remains that the dollar will continue to be the point of reference, and it will provide the United States with considerable power period ahead through essentially a balance of terror. China has more than $3 trillion in reserves. Japan has 1.5. It's a lot of money. Any kind of shift of world money away from that would be enormous losses for these countries. On top of that, the idea that Chinese accumulation will continue and trump ahead is, of course, not true. China has ended what is called the new normal. There are significant problems, domestic problems of accumulation in China, which we discuss in our work. The easy period of rapid accumulation in China is not there any longer. Chinese accumulation will become far more complex and difficult in the time ahead. In other words, the long and the short of it is, we've entered a period of hegemonic contests in which the United States declines. There are new contestants from the old periphery. There is no obvious way in which one of them will dominate. What we're in for is intensified competition, which exacerbates the Third World War. I don't need to go very far. Just look at what's happened since 2022 to get an idea of it. And I want to finish by what might be possible. What does this mean for heterodoxy, and what does it mean for alternative ways of organizing? What does it mean for workers, the poor, and so on across the world, which is, of course, what matters to people who approach things critically and radically? Well, this extraordinary development, this interregnum, which is so dangerous, has emerged while the left, which is traditionally the voice of opposition and generator of new ideas, is at its weakest point historically. I can't recall a time, and I don't see it in history, when the left is doing weaker than it is in the moment. The left is a current, it's a tradition, I don't mean it's a political party. And there are two fundamental reasons for this, which we discussed briefly now. The first is, of course, the left has become detached from the poor and the working class. He has lost his organic score. And the second is the left is confused ideologically. It's gone on a trip somewhere. He doesn't know where he's at. He keeps talking about this, that, and the other, and doesn't talk about capitalism, it's political economy. But if the left is to say something which is useful, it must start with political economic capitalism. The moral critique of capitalism, the gender critique of capitalism, whatever else, they're all very important things. Even the aesthetic critique of capitalism is a very important thing, right? However, unless you have a political economy critique of capitalism, you're not getting it. So the left has lost capacity to do that, and that is one of its biggest problems. And so the interregnum gives birth to monsters, and to morbid symptoms, as Gramsci called them. And yet, it is not so difficult to see. It's not so difficult to see what an alternative might be. There is a lot of agreement among people who engage in heterodox analysis and Marxist or non-Marxist analysis. It's not so difficult to see. And it's also difficult to generate document supporting it. The first thing that's necessary is obviously productive restructuring. In other words, deglobalization and definancialization. How that happens, it depends on countries and it depends on the organization and agreement across countries. But we definitely need both deglobalization and definancialization. That is the way to begin to group sensitively towards environmentally aware organization of production and the distributed policies. This is general agreement. So it's not as if we have to rediscover the wheel or anything of that. That's the first. The second point that is paramount for confronting the interregnum is, of course, to re-emphasize the importance of democracy, but democracy in a meaningful way. Because, as I pointed out, the huge role of the state at the core goes together with the negation of democracy. The more that they talk about democracy, the less that they practice. Because you see, democracy is not simply the ability to vote every 4 years. Democracy needs intermediate structures, otherwise it's devoid of content. It needs organizational structure which have weakened. It needs trade unions, it needs community organizations and so on. So we need this in order for democracy to be. In other words, we need popular sovereignty. The thing that has become weaker across the world. The third thing that needs to become very prominent is, of course, anti-imperialism, but anti-imperialism without emphasizing national sovereignty means nothing. Means nothing, and the left doesn't understand this. It's lost capacity to understand what national sovereignty means. It thinks that national sovereignty means fascism or anti-immigrant this or whatever. It doesn't. It doesn't. It means command over the instruments and facilities of democracy locally. That's what it means. Ruling the place where you live. So national sovereignty is fundamental to anti-imperialism. There is no anti-imperialism without national sovereignty. The last thing is, of course, command over the state. This is the big elephant in the room, which the left doesn't want to confront. An open state is pivotal to contemporary capitalism. It's impossible to globalize internationalist capitalism without community state. It would collapse. How the state works, what we say about the state, how we deal with the problem of the state is paramount for the left. The world needs new proposals, new ideas about how that would work in the realm of money and more broadly. In developing these new ideas, and with this I will finish it, it's difficult, and it will depend on each country, for sure. There are no prescriptions that apply across the board. But there are a couple of things which are fundamental in which we learn from our tradition. And that is, the social is superior to the private. The collective is superior to the individual. Doesn't mean that we disregard the individual and the private, of course. But the guiding principle is that the collective and the social are the dominant elements here. That would allow us to redefine socialism for the years ahead, and that might begin to provide an answer out of this disasters of the internet. Anyway, thank you very much, and I look forward to this slide.
Okay, thank you very much, Costas. It's a little bit of drama. So we heard some great lessons about the interregnum. We prepared a very short discussion with one of our PhD student discussants. We limited to just 2 questions. So he traveled all the way from Bristol. So we're going to do a very short 2 questions from our discussants, and then we'll open the floor for open Q&A. Okay. So Raven, do you want to? Oh yes, I will stop sharing.
Read off the computer, please.
Is everything good? Oh yeah, I think you can see us.
Yeah, well, yeah, thanks everyone. Thanks, Costas, very much for your presentation. It was excellent in ways. Scope of this work makes it quite difficult to choose just one or two aspects for further discussion, but hopefully the following Q&A will cover any of the other aspects that are left to address, which there will be many. I'd like to focus on two aspects of the work. Firstly, at the national level, the question of inflation. Secondly, on the global level, regarding the prospects for a new multipolarity, whether or not this is desirable. And again, of course, considering the role and interaction between production, finance and the state throughout. For the sake of brevity, I'll be embellishing some of the following narratives quite heavily, so please do overlook any missed nuances. So on the inflation question then, in your latest book, you highlight how the neoclassical quantity theory of money, simplified, that is the idea that money creation leads to more inflation, is inadequate to understand or properly address the current bout of inflation. Not least in spelling this myth is the lack of inflation, say, following the 2008 financial crisis period. So excluding, of course, financial markets and property markets. Japan is a key example of this. Had chronically low inflation for a very long time, despite being one of the first states to implement the state of easing. So instead, what characterises inflation in the period following the pandemic is in fact a breakdown of global supply chains and a disruption to the production process itself, restricting supply, which enabled firms to increase prices in response to resurgent demands after lockdowns. During lockdowns, a portion of the population, the core, builds up savings due to less consumption of services. That, I would argue, I think you argue, it creates huge speculative bubbles in stock markets channeled through these shadow banking institutions such as mutual funds. And of course, despite the pre-existing persistently low levels of productivity, profitability, investment in all those sectors of the economy, with the exception of some such as digital services. As restrictions ease, some of these funds started making their way back into the economy, increasing demands while supply had yet to catch up. The state went to great efforts to prop up business during the pandemic, for example, using the job retention scheme and guaranteeing low interest loans, a substantial amount of which was lost to fraud, around about 6 million. As inflation began to take hold after the lockdown, the government's approach changed and again focused on hitting the somewhat arbitrary 2% inflation target. The blunt tool used to achieve this took the form of rising interest rates, predicated on the highly dubious and not completely defunct Phillips curve, the idea that low unemployment is the main driver of inflation. By raising rates, the state, in the form of the Bank of England, objective was to increase unemployment, weakening workers' already weak bargaining power in this period that you speak about, the kind of globalized, global financialized global economy, thus making it harder for workers to negotiate for higher wages, due to, of course, the threat of being replaced, being made unemployed. In addition to that, workers' purchasing power was further reduced by the introduction of the stealth tax, freezing the tax-free allowance, contributed to the highest levels of taxation in roughly 100 years. Meanwhile, corporations received subtle but generous tax breaks in the form of capital allowances, in a misguided attempt to encourage investment, which seems to have had little to no impact. Evidence, as you say, not of states versus markets, but states for markets, states working on behalf of capital. The result of this policy has been the transfer of income from workers to corporations, as can be observed from the below inflation pay increases and above inflation corporate profit rates. Even neoliberal institutions such as the IMF and the ECB have produced papers contributing close to 50% of the recent inflation to corporate profiteering, yet this hasn't changed their response. One response to this might be the lowering of interest rates, running the economy hot in the neo-Keynesian sense, allowing the unemployment rate to fall further to achieve close to zero unemployment, giving workers more bargaining power, you would think about in terms of the Phillips curve framework. However, as you emphasise in the book, this policy without significant measures to address the issue of investment and production would run into resource constraints quite quickly. The past decades' experience show that free markets don't have the ability to efficiently or productively allocate labour or other resources. An alternative to this could be the introduction of price controls. This would force companies to absorb higher input costs, effectively redistributing income to labour. Arguments against price controls usually relate to the importance of price signalling as a mechanism to signal to producers where to invest, where investment needs to be, as that will be where they can make the most profits. This theory is predicated upon many dubious assumptions, such as free and perfectly competitive markets or no barrier of entries for would-be investors. And so substantial distributed profits from large monopolistic corporations, dividends and share buybacks are evidence against these assumptions. So the first question then is, are price controls a practical solution, but are there more effective ways to control innovation in a manner that benefits workers at the expense of capital? On the second question, this one will be a bit shorter, sorry. You emphasise in the book that policy options available to periphery states to combat inflation are significantly inhibited as compared to core states, due in part to the need for periphery states to maintain their exchange rate against the dollar and keep control over their dollar-denominated liabilities. If the dollar goes up due to rising rates in the US, many countries will be forced to follow suit or face financial ruin due to the increased cost of financing their debt. That is, in many cases, they do anyway. So whereas a core state with a strong currency might have the option for lower rates, lower rates rather, a periphery country wouldn't have that option, as can be seen from the case of Turkey, where they tried to lower rates to combat inflation. That's the framework. Simultaneously, any attempts at addressing social issues through fiscal stimulus would scare investors, your periphery state that is, causing capital flight and worsening the XR position, exchange rate position, sorry. Some countries, such as China and South Korea, were able to offset the initial shock for a time due to their substantial dollar reserves, which they could sell off to offset the depreciation of the currencies. But recent geopolitical events have raised questions and concerns about the viability of that option going forwards to any would-be enemy of the United States, which is the overseer of the US, of world money, as they say. And also, I think there's questions about whether or not China really wants the US dollar to decline. I mean, considering it's been exporting actual raw materials and goods in exchange for bits of treasury paper for the past how many decades. So again, following the Russian invasion of Ukraine, in an attempt to inhibit the Russian response to embargoes, the US Federal Reserve restricted the Russian central bank's access to dollar reserves, preventing it from being able to adjust its exchange rate. This sent a signal to other countries that their dollar deposits might not be safe as once thought. And perhaps that is attributable to the slight shift away from the US composition of global foreign exchange reserves. So, when you point about China and whether or not China is really a safe place to keep your money, given the state's control over finance, is the dollar necessarily a safe place now as well. I mean, obviously, that's not the same scale as China, or less. In addition to this, deglobalization, the US desires to want to reshore production to protect supply chains, restricting access to dollars for some exporters, and simultaneously there is a looming shortage of many commodities important production, many of which originate in periphery countries, potentially giving them some leverage in the new emerging multipolar economy. So, but also, as you point out, intensifying hegemonic contests. So some are arguing that this will lead to the end of fiat money hegemony, particularly US dollar hegemony, and a return to commodity money. So the question there is, to what extent do you think that this is correct? So the end of US dollar, I mean, you already alluded to this, but to what extent do you think the US dollar hegemony is ending, and what implications does that have for global production going forwards? And are these kind of sounds coming from the BRICS about creating a new kind of currency bloc viable, and would that even be desirable? So thanks.
Okay. Did I take these now, or should we broken it out? It's broken out the discussion. Should I take them now?
Whichever you prefer.
I think because time is running.
Okay.
Maybe we should take more, and then I'll answer. We'll blend one, because otherwise it won't be any time for.
Okay, yeah. So should we take one question from here, and then one from online, and then do you want to start answering then?
Yeah.
Okay, so let's get one question here in person. If not, I will read out the two questions from online, and then you guys can think of a question in the meantime. Please do that. So yeah, so many people on Zoom, I'm going to read it out for today. And Ian has asked, how long can an interregnum last? Obviously not an exact mathematical question, that one, but after a certain length of time, should it not be characterized as the new normal? Are we approaching that point for zombie neoliberalism? And then the second person asked somewhat similar kind of question. Candy Coral asked, he has 2007 to 9, which to me is a marker for one of capitalism's crises, which is the novel. I like Yanis Varoufakis' new interpretation of zombie capitalism to techno-feudalism and cloud capitalism because it is based on a larger era in terms of time. So that were the two questions from that. Oh, okay. Should we start with these ones and then we'll get on next? Yeah.
Thank you to Raven for the questions. Inflation was something we discussed extensively in our work. It's something that concerned us because we started doing this work when the pandemic broke out. For us, the intervention by the state, core states in the pandemic was extraordinary. It was an extraordinary event. I know we become used to it, but if you think back, it's phenomenal. Because you go through time when people argue the state can't do this, can't do that. The state can't do. I mean, the modern state shut down entire economies in a weekend. I don't think the state has been more powerful than ever, right? And then it began to create money on an enormous scale and started even sending the money through the post to people, right? Most of the businesses, but even to individuals. You've got to recognize these facts, otherwise we're not gonna. So the power of the state for us was incredible, and we're going to analyze it, and we pivoted the argument on the control of the fiat money. But obviously, for us, we use Keynes' analysis, but also Marx's analysis for this, it was clear that there are constraints, and we discussed it. We discussed how central banking works. We discussed how shadow banking works in this context. There's a lot of material there. The key point for us was simple. If production and the productive structure is misfiring, if accumulation is weak, and the state expands aggregate demand strongly, and then private demand also comes in 2021, you're going to get inflation. To us, it was clear, and we argued along those lines, and that's what happens. It's not the quantity theory of money, because it isn't directly due to. It is the boost of aggregate demand, which cannot be met by supply, which is under pressure in this way that I've outlined. That is the fundamental thing for us. So what happened there? One of the biggest income transfers that we witnessed in years. Because obviously, the Interregnum has been a period of inequality. I didn't discuss it, but it's obvious it's a period of inequality. In the post-pandemic period, there's been a period of extraordinary income transfers through inflation. When inflation goes up, company profits go up, wages, real wages go down. That's a net income transfer out of people's pockets into the profits of corporations. In that context, obviously, price controls are very important, and we were supported the idea of price controls. But the real answer must be supply-side restructuring. The real answer must be that the experience of inflation points to that. So the answer is, that's a very important point. The left has spent years talking about aggregate demand expansion. You understand, the argument against austerity is an argument about aggregate demand. Austerity is it's constraining aggregate demand. Austerity isn't instrumental. It might or might not happen. It depends on choices. What is fundamental today is supply-side restructuring, productive restructuring. That's the argument for the left for us, not demand management. Not demand manipulation. Demand manipulation, the ruling bloc can do, and it does. And it ends up with inflation because that's the constraining factors which we've discussed. So that's the answer I will give you with regard to this. And when it comes to multipolarity and the role of other currencies, I like that term multipolarity, but I just want to stress a point here. Because people can't oppose it to unipolar, rather the multipolar world is supposed to be good. If you listen to what the contestants say, Putin, for example, he talks about the multipolar world, but then it's a good world. Well, I have news for that too. The world prior to 1914 was a multipolar world, and it didn't end up well. Right? It didn't end up well. So a multipolar world, if the contest is driven by economic interest, is not necessarily a good thing. I'm not in favor of a unipolar world, obviously, And it's a good thing to see the decline of US hegemony to some extent. But be careful what one wishes for. The answer is not necessarily multipolarity. The answer is national sovereignty and popular sovereignty. That's the answer. From the perspective there, not necessarily multipolarity is a very dangerous thing. But anyway, to come back to the point about currencies. What we're witnessing today is the rise of the small fry, and that takes the form essentially of swaps, currency swaps, occurring at the margins of the world market, changing the hierarchy of balance sheets. The way the Federal Reserve dominates the currency market is by making its balance sheet available to selected central banks, as and when the United States chooses to do so. It's a lever of imperial power. So come a critical moment where people need dollars, participants in the world market need dollars. The lever of imperial power is to make dollars are produced by the Federal Reserve, right? Is to make the balance sheet of the Federal Reserve available to selected central banks, which then ease the pressure for their own domestic accumulation. Who obtains that privilege is very much a matter of political choice, hegemonic choice by the United States. It's not an easy thing to come by. And what has emerged, interestingly enough, the last 10 years in the Interregnum that I've shown you, is the ability of some smaller central bank to engage in bilateral balance sheet swaps. I don't think that this has potential for very great expansion, but it's indicative of the crisis and the pressure. People are seeking different ways out, which they cannot easily find. It's very difficult to see how the renminbi can do that without a dramatic transformation in the organization of domestic finance in China and international transactions, and obviously without some kind of technological shift. So I would caution I would urge great caution when it comes to thinking through that. Not to deny again that there is a need and a search for alternative modalities, right? Some of us have been around with this particular model for many years. And every time there's a crisis, the world goes back to dollar. So that is a very, very important. Which brings us to the key question: how long can an interregnum last? Well, if only I knew. What I can tell you is that at the level of the top, the decision making among the established imperial powers, there seems to be very little understanding of what is at issue, particularly in Europe. And it's interesting to see the old imperial powers are in Europe, right? The powers that used to dominate them. They are the weakest. Europe is its weakest point in a long time. It's a basket case when it comes to its world presence. And it's a basket case when it comes to projecting power. I've never known it to be weaker than this. I mean, the successive governments in Europe are just, I want to be polite. Myself, it is very difficult when we think of who runs Germany, who runs France, who runs this country. It's just difficult to articulate. So that is not accidental. It goes together with the inability to find an alternative way forward. And ultimately, it is very difficult to see how that would be, because the dominance of globalized productive capital and globalized finance is not really seriously challenged. And I don't think it will be challenged without interventions we'll talk. What would generate that? I don't know. Usually the regulations finish with some major events, some major global events. I don't see one. I hate to think that the war might do it, and I'm not going to argue that. But at the moment, I don't see any signs that make me think that we're coming to an end and the opening of new phase for the decade that ends. Maybe I'm not, but it's difficult to see. Last but not least, techno-feudalism. I'm very, very suspicious of these newfangled terms that usually are very difficult to understand. New technology is very important, and we do discuss to a certain extent big tech in our world. Big tech is not as important as people think. It's not particularly well connected to other parts of the economy. It's a self-sustained, self-contained thing. it's very, very prominent, but it's not that important. And the impact of new technology on productivity, as I've indicated, is very, very important. What has been crucial here doesn't seem to be forthcoming, certainly not in the years ago, the Interregnum is this. Productivity growth, which has been weak at the core, was very strong in certain countries of periphery, which is how new centers of capitalist accumulation emerged. Productivity growth was very, very powerful in China, obviously, but also in India, in Korea, and elsewhere. This has been one of the factors which has allowed core countries to continue, because they benefited from the productivity in these peripheral countries. The ability to do so ahead seems to be more limited, seems to be far more limited than before. That seems to be coming to an end. And the second point, which affects Europe, which is more crucial, is access to cheap energy. Much of the Interregnum and before has been dominated by cheap energy made available in Russia and that's been. So the combination of these effects for Europe, at least, so I see no easy way out for Europe, and possibly a gap opening up with the United States. But these are speculations. On the whole, to answer the question, it's very difficult to see. We are way out and predicament for the time.
Thank you. So because of time, I think we're only going to get the questions from the two people earlier, and then we will have to wrap up. Do you mind coming to the front so that people on the Zoom can hear your questions as well? Those of you who wanted to ask earlier. I remember there were two people who wanted to ask questions in the room.
I'm scared.
So yeah, do you mind coming to the front and then say it, or okay, you?
I mean, I'm sure you're not hearing.
It's because of the mic. But
It's for the Zoom people, or should I? Okay, I'll repeat for you. Yeah.
No, my question was more on because you said we were talking about global value chains and about how kind of like capital essentially does not require borders anymore, and you also mentioned shadow banking and how both processes of financializations, and my wonder was, well, considering how like the accumulation tendencies of capitalism, right, and how inequalities is getting stronger and stronger, and we see the power and capital of multinationals that you're saying that they're sitting on piles of cash, right, and so they're delinking from what was before kind of the core working of capitalist development, so the banking cycle, right. Since with globalizations and the globalization of productions, we operate outside of that framework of national boundaries, and so how actually states right now are giving up their democratic power and in order to allow for the hypermobility of capital in this sense, and only allowing for certain players to play in this arena. And then we know that, for example, in US politics is very much due to what's it called? Like lobbying, for example, right? And so how that has the power of changing policymakers' ideas and shifting popular opinions through also like information technology, right? With which the more capital you have, the more power you have, the more access to those capital technologies, and especially like social media and stuff like that. So my wonder is, what if like we're not necessarily in a landscape where we are talking about, and you also talked about e-currencies, right? And so what if the delinking properties of modern and modern capitalism, right, together with the shadow banking and with like e-currencies, for example, and let's say that the only thing that's missing right now is a state such as like I don't know, like a tax haven, for example, or any state that can say to multinationals that, you know, you can put your headquarters here, and then they still command the global production, right? And then they sit on ever larger piles of capital, but actually in the West or core countries, you have rising inequalities, and that's also the reason why we have, you know, popularism rising, and we have highly strong divisions within the same state, right? And so it becomes very difficult to rule as well. And then the more you move towards that kind of a line for the transformation and the mobilization of capital, the more.
What's the question?
Oh, sorry. Like, do you think that that could also be the chance that multinationals, because they're in control of global value chains and everything, can become that powerful? So to kind of reproduce.
So I hope I can summarize correctly. So the question from the room was, in the era of global value chains, so the like borderless society, development of IT, so the multinational corporation power becoming very strong, and the democracy. So like, can they overpower the
Yeah, shall I answer that?
Is there any more question in the room? Should we wrap up with that?
Yeah, it's done.
Yeah. So that will be the final question. Thank you.
This question is an important question, but it's 10 years late, or it's 10 years out of date. This is a question that relates to debates as they existed in the 2010s and before. It's a question determined and driven by a certain kind of ideology of the state versus the market that was very prevalent, and it emanated from finance. That's not how the world works. It's not a contest between multinationals becoming very powerful, transcending borders and dominating the state. That is all that now, right? That's not how the world works, manifestly so. Without the state actively intervening at all stages, there's no such thing. The global value chain would collapse in a weekend. It was obvious the pandemic brought that about. It was manifest. The real question is to understand how globalized finance and globalized production interact with the states. That's the real question. That's the real issue, because they cannot operate without the states. It's not true that they overcome and surpass. That's not what's happening. And I indicated to you that neither of these things can happen without good, globalized finance, without good access, secure access to global reserves, world money. Access to world money is fundamental for value chains. The way value chains would work would be to secure finance, to secure access to good quality finance. Good quality finance often means access to foreign currency to allow to operate. Whoever controls that can exercise power over the chain. I know value chains are very complex affairs, but they cannot exercise power over the chain. That entails usually guaranteed access to the dominant world currency, whatever that might be. That's not possible without a slave. The state has to do that. How it does it, it's a very difficult thing. The second thing that also matters here is that global value chains also typically have some kind of key enterprise, within them, whether there are property rights or not. Within them. This enterprise proposes, but more often than not, at the point of crisis, it comes to depend on the state. It's the analog of what input rates about banks. Banks are international in life, very national in life. So when there is danger, you really typically end up asking support from the state. And the true character of so-called globalized productive capital becomes very low aggressions. Without the state, it doesn't really work in the much. So I would encourage the examination of these type of relations rather than abstract relations about these types of capital overcome. There is no overcoming in the states. The world is divided into a number of states. Some of them are more powerful than others. Some of them deny national sovereignty over others, and that's how the world works. And the ideology of the state being overcome typically emanates from the dominant state, the United States, which is the only country until recently which would talk about the national interest. Openly so. So that is how one should approach it usefully for the period. The last point I want to make is on finance. Much of this ideology is emanating from finance. You can see it's logical from finance because it's the original globalized
doesn't recognize borders particularly. So long as the institutional conditions that allow you to make a profit, you can cross the borders fairly, far more easily than for production. All you've got to do is lend money, and then guarantees that the money will be used and come back to you. Difficult thing, but not compared to production, right? So it's emanated from financing its own logic, and it is precisely this type of capital that is the most dependent on the state. So we've got the paradox whereby the most globalized form of capital, which keeps talking about we're going to be the state, is precisely the form of capital that needs a state more than any other. And that's clear in its everyday practice, but also in times of crisis. That's how we should approach it. The state today is crucial, and it's very different between core and periphery. It's really the differences that we should be looking at, rather than any general theory about the state withering away and capital dominating. It's only in the imaginations of people. Possibly dying about that's what the works. That's all I'm going to say. You understand the British. Thank you very much for your attention.
Thank you, Costas, thank you, Raven, and thanks everybody for attending, everybody on Zoom as well. We will see you next week with Paula's lecture on Zoom and